Hey there, Ken Zorvich, NFM Lending. Hope you're having an excellent start to your weekend. So, without a doubt, the question I get most from people in everyday life is mortgage rates and when are they going to come down, right? Are they going to stay up forever? But let's just back up and talk a little bit about why mortgage rates are high. Mortgage rates are high for two reasons. One, anytime you have an economy that's on the, let's just call it on the up, meaning stocks and businesses are turning in good earnings and people are spending money, you're always going to see high interest rates. You generally see low interest rates when there's issues going on and we want to promote more borrowing, right? We want to get more money in the system. Hence why people got really low rates during COVID, because we all thought the economy could collapse. Let's keep money in the system, right? Simplest way to understand it. If the economy is, just crushing it, you're going to have high interest rates, right? All right. So that's a kind of a brief explanation of how we got here, right? Second is obviously the Fed wanted to slow down the real estate market because we were a bit out of control with appreciation and supply versus demand and all that. When we had low rates, low supply, it just was a breeding ground for higher values. So now the Fed would like to slow that down and they took some measures to do that. Now, what do credit cards have to do with all of this? Now, interest rates are only going to come down if the economy starts slowing down, if there's reasons that there are cracks in the economy that are going to start to see either layoffs or corporate earnings come in less or less spending by consumers. So the reason why I want to talk about credit cards, because I don't think this makes the news enough, and there's three areas I want to point out. So first of all, let's start with consumer sentiment. Okay, consumer sentiment actually is a measurement that gets done like on a monthly basis. And right now it's been dropping for two consecutive months. Now you might say, okay, well, is that unusual? No, it's not unusual, especially at the start of the year. But there's a lot of things happening right now between changes in politics, economic changes that the administration's putting out that seems to be scaring consumers. And a lot of them are scared of tariffs. And I don't think they fully understand tariffs because we don't know what the impact tariffs will even have on us until we get further downstream. But it's enough to get consumers worried. And what do consumers do when they're worried? They don't spend as much. Now, second thing is credit card debt. Okay. We are over $1 trillion in credit card debt right now, the highest we have ever been. And if you look at this chart, you'll see that during the pandemic, we saw a distinct spike downward. And why was that? Well, people started to make more money because the pandemic didn't financially impact the collective as much as we thought. People got money from the government, which they used to maybe pay down debts, and people were saving more because they were spending less. They didn't have discretionary income. It was just about survival. They weren't going on trips. They weren't buying luxurious items. And then what happened is we kind of flipped the script, and then you see the big spike up in credit card debt. Now, I say credit card debt because this is not necessarily getting paid down. It's just continuing to grow. Okay. So you say, okay, but doesn't the music have to stop at some point? And yes, that's the point, is that why did this debt grow over the last 2 years from say 22 to 24? Well, the reason is because we'd all potentially been accustomed to a new lifestyle. And that lifestyle meant we're earning income, we're spending money, we're trying to keep up with the lifestyle that we have now after COVID. And that also included people taking on more debt. But how much longer can they do that? That's the question, right? We're kind of hitting a tipping point here. Now, finally, the last thing I want you to look at is credit card delinquencies. Now, credit card delinquencies have started to rise. Now, why is that? Well, maybe the economy is slowing down, consumer sentiment is waning a bit, and also it was just tough to keep up with that, right? If wages are not growing enough, and people aren't bonusing enough and people can't keep up with those credit cards, you're going to start to see delinquencies rise. Now, none of this is doom and gloom to where I think that the economy is going to collapse. But what this all means is that we're hitting a tipping point, and that tipping point could mean, do we start to see consumers spend less? And if consumers spend less, are business earnings coming down? If business earnings are coming down, the stock market is slowing down. If the stock market slows down, people run to the bond market, and that causes interest rates to go down, right? So these little things that are happening out there in the market probably don't make the headlines enough, but it kind of shows you why I think we're going to start to see mortgage rates come down as the year goes on, because these things are all happening and unemployment could start to rise with some of the changes that both companies and government are making when it comes to that. So listen, I think what you want to take away from this is understand what's happening behind the scenes of some of the economic indicators that are out there. But also, too, I've seen people that are now refinancing to pay off credit card debt. If you know someone or if you want to have a conversation about that, we can. There could be ways that you're not sacrificing this low interest rate to at least get your credit card debt in order. But I would hate for someone to ever lose their house because they were trying to fight off a credit card. At the end of the day, it's most important to keep that asset. So, look, get in some time with some friends and family this weekend. And as always, I'd love to be in this business in 5 years. If you know someone looking to purchase or refinance, please think of me. Have a great weekend.